Good evening, guys. Guys, we'll start the session in a couple of minutes. We'll discuss the few important economy topics. We have already covered at least 30 to 40 topics before. We have covered important topics from national income. We have covered important topics from fiscal policy. We have covered important topics from inflation and unemployment and also external sector. So this we have covered already. If you have not watched the session before, please go and watch it. In today's session, we will cover very important topics from the monetary policy and from the capital market. From the monetary policy and the capital market. So before we start, guys, just tell me in the comment box, can you hear me? Can you hear me, guys? If you can hear me, just please do let me know. Not watch the session before, please go and watch it. Okay. I think I'm audible. Okay, I think I'm audible. Guys, give a thumbs up to the video if you can hear me loud and clear. Guys, first of all, tell me, have you watched that session on national income, fiscal policy, inflation, unemployment, and external sector? Have you watched it? Okay, please tell me quickly. Please tell me, guys, have you watched it? Important sessions. How many of you watched it? How many of you watched? Please go and watch. See, why I'm saying you is that I was analyzing the economy paper last year and there were around 14 questions on economy. Okay, there were 14 questions on economy. Okay, and in these 14 questions, 5 questions were from monetary policy and capital market. Monetary policy and capital market. Capital market 2 questions, monetary policy 3 questions, and the rest questions, the rest 11 questions, okay, 2 questions were from the external sector. Then there was 1 question on, I think, inflation. Okay, and then there were few questions on, okay, some related topics. Okay, like self-help group, MSMEs. Okay, those kinds of questions. So I personally believe that this year, definitely there will be a question on capital market. At least 2 questions I'm expecting again from capital market. From this video, I will try to give you at least 2 questions from the capital market and at least 2 questions from the monetary policy. Okay, so this video will help you, okay, get at least 4 questions. Okay, that is my firm belief. So let us start, guys. The very first and important topic is that India's market capitalization has hit 5 trillion milestone. 5 trillion milestone. Okay, so can anyone in the comment can tell me what is India's GDP? What is India's GDP? Can anybody tell me what is India's GDP? Quickly, in the comment box, can you tell me what is India's GDP? What is India's GDP? See, market capitalization of India's stock market has reached 5 trillion. Okay, 5 trillion. But what is India's GDP? Okay, and through that, we will be able to know that, okay, you can see here that India's stock market is overvalued. Overvalued. Okay, because market capitalization, okay, GDP ratio is more than 1. It has reached 140%. It has reached, yes, it's around 3.7, 3.8 trillion and approximately 4 trillion. Okay, GDP is approximately 4 trillion. Okay, 3.8, I think 3.8 trillion. But the market capitalization is 5 trillion. Generally, it should be what? Generally, it should be what? The market capitalization is equal to GDP. Okay, when it is equal to GDP, it is okay, fairly valued. Market is fairly valued. But if it is market capitalization below GDP, then it is what? Okay, cheap. Market is cheap. Right now, market is what? Premium. Costly. Market is premium. Is this clear, guys? Is this clear? First topic is clear, guys. Okay, so guys, India is now the 5th largest, okay, market in the world in terms of market capitalization after United States of America, China, Japan, Hong Kong. China, Japan, Hong Kong. Is this clear, guys? America, China, Japan, Hong Kong. America, China, Japan, Hong Kong. India is now the 5th largest MCAP of the companies which are listed in stock market. Is this clear, guys? Okay, now you can see here, guys. You can see here, guys, market cap to GDP ratio. Market cap to GDP ratio, it was in 2007, it was 98%. In 2017, it was 82%. In 2021, it was 110%. In 2023, it is 120%. And in 2024, it is 154%. You see how much overvalued our markets have become. How much overvalued our markets have become. 154%. Okay. So you can see this. This is very, very important. This is very, very important. So what is the ratio which is used to determine is the market fairly valued or overvalued? It is called the PE ratio. It is called the PE ratio. PE ratio stands for price to earning ratio or price to earning multiple. Price to earning ratio or price to earning multiple. It is the ratio of share price of a stock to its earning per share. Okay, to price of share divided by EPS. Divided by EPS. Is this clear, guys? EPS means what? Earning per share. EPS is what? Earning per share. So they will just write you. They will just give you in finance. They will give you question like this. They will give you question like this. In finance, what is PE ratio? What is PE ratio? Okay, so they can give question like this. Okay, so it is basically used to, okay, assess the worth of a stock. The worth of a stock. Okay, guys, is this clear? Guys, are you following? Guys, give a thumbs up if you are following. If you are able to follow, give a thumbs up. If you think these topics are important, okay, please do consider liking the video. I hope I'm able to help you. Okay, this video was demanded by many students that, sir, please take a session on like capital markets. Okay, so this is a demand session only, guys. Okay, next is, guys, you can see the SEBI is going to, okay, SEBI is going to relook the categorization of companies. Relook the categorization of companies. Right now, guys, categorization of company is the price to earning ratio. Full form of PE ratio is price to earning ratio. Price to earning. Okay, you can see this price to earning ratio. Full form is price to earning ratio. Okay, now let us see, guys. So there is a demand. There is a demand to review the basically the categorization of companies listed in the stock market. So right now it is what? Large cap, mid cap, and small cap. These are the three categorization, guys. Large cap are companies which are top 100 companies listed in stock market. Top 100 companies listed in stock market is called large cap. They have market capitalization of more than 20,000 crores. More than 20,000 crores. These are called large cap companies. Then comes mid cap companies. Mid cap companies 101 to 250. 101 to 250. Here the market capitalization is more than 5,000 crores to 20,000 crores. More than 5,000 crores to 20,000 crores. Okay. And last is the small cap. Small cap is beyond 250. Okay, beyond 250. These are less than 5,000 crores. Market cap of less than 5,000 crores. Okay, is called, okay, the small cap. Okay, guys, is this clear? Is this clear, guys? Okay, so 1 to 100, then 101 to 250, then 250 plus. Okay, so guys, now they are asking to review this market capitalization. This can be used to frame question. This can be used to frame question, guys. Be ready for such questions. Guys, what are called blue chip stocks? What are called blue chip? What are called blue chip, guys? Blue chip. What is called blue chip, guys? Quickly in the comment box, I need answers. I need answers. What are called blue chip? I need answers, guys. What are called blue chip? Blue chip companies are the large cap companies. Large cap companies. Okay. Very high market capitalization like Reliance. Okay. Airtel. Okay. These are called blue chip companies. SBI. State Bank of India. SBI. These are called blue chip companies. Okay, guys. So how is market capitalization calculated, guys? Market capitalization is the total value of all the shareholders, okay, have assigned to a firm listed on a stock market. Okay, so any company which is listed in the stock market, what value the shareholders are giving to this company is called market capitalization. It is equal to multiply the stock price, okay, and the number of shares which have been listed. Okay, so suppose share price is 100 rupees and there are total number of 100 shares. So market capitalization will be how much? 10,000 crore. Okay, 10,000. Okay, is this clear, guys? Is this clear? Market capitalization. Which company has the largest market capitalization in India? It is called Reliance. Okay, it is having 20 lakh crore. 20 lakh crore market capitalization. Okay, guys. Okay. So guys, another concept is the large cap fund, mid cap fund, small cap fund. Okay, guys. So I have already told you what is large cap fund. So fund which invest in large cap companies are called large cap fund. Fund which invest in mid cap companies are called mid cap fund. And funds which invest in small cap companies are called small cap fund. Why this is in news? Because SEBI has asked for stress test of this mutual funds. Okay, guys. Okay, everyone is clear, guys? Everyone is clear? Please do tell me if you have any doubts. Okay, next, guys, they can ask you SEBI. What is SEBI? So guys, Securities, okay, Exchange Board of India is a regulator, is a market regulator, capital market regulator. It is a capital market regulator, SEBI. Okay, you can see SEBI is a capital market regulator. Okay, and you can see here that the role of SEBI is quasi-judicial role, quasi-executive role, and quasi-legislative role. It basically, okay, SEBI is responsible for, okay, regulating the capital market. So regulating the security markets, monitoring and supervising the market activities, promoting investor education and protection. This is very, very important. Okay, promoting investor education and protection, and promoting development of securities market and enforcing securities regulation. Okay, so this is what is SEBI. SEBI has penalized many fin influencers. Okay, SEBI has penalized many fin influencer. Very, very important. Okay, SEBI has penalized many fin influencers. Okay, SEBI can penalize also any insider trading, any kind of things which are prohibited. If you do it, then you can be penalized by SEBI. Also, it has quasi-judicial role. Okay. Next, okay, I would like to tell you that there are two funds. One is Investor Education and Protection Fund. One is Investor Protection and Education Fund. Okay. So there are two different funds. Investor Protection and Education Fund. Investor Protection and Education Fund. It is under SEBI. And Investor Education and Protection Fund is basically under the corporate ministry. It's under corporate ministry. Okay, so this is two things you need to know. Okay, this fund is regulated by Investor Education and Protection Fund Authority. Investor Education and Protection Fund Authority. This is different. Investor Protection and Education Fund. These two are different, guys. These two are different. Okay, so you should know the difference between these two. Okay, so do not get confused. IEPF, it is under corporate ministry, and IPEF, it is under SEBI. Okay, I hope you get it. Guys, are you following this? Everybody, are you following this? Do you have any doubts? Okay, next, guys, Mauritius route. Guys, you all know that India has basically brought some changes in the treaty. Guys. Okay, the double taxation avoidance treaty, where they have brought some principal test. Okay, in this context, okay, why Mauritius is the favorite route of foreign investments into India? The reason is tax evasion. Okay, because India has double taxation avoidance agreement. So what happens is round tripping happens. Round tripping happens in. Okay, this is clear, guys. Are you getting it? Anyone has any doubts? Please prepare. Okay, they can give you what is the principal purpose test. What is the use of the principal purpose test? It is basically for preventing any tax evasion, to prevent any round tripping, Guys, what are tax havens? Tax havens are countries with low tax jurisdiction. Examples of tax havens are Andorra, Bahamas, Belize, Bermuda, British Virgin Island, Cayman Island, Channel Island, Cook Island, Jersey Island, Hong Kong, Isle of Man, Mauritius, Liechtenstein, Monaco, Panama. Okay, so these are many tax havens. Are there, guys. Okay, is this clear, guys? Very, very important, guys. These topics are very, very important. Sir, tell me once more, round tripping. See, round tripping, the name only saying round tripping. So what you do, you open a shell company. In a tax haven. Okay, you open a shell company in tax haven. Okay, tax haven. Okay, and then what you do, guys? Okay, you give money from India to this company in terms of under invoicing or over invoicing. Okay, under invoicing or over invoicing, and then from this shell company again you invest in India. This is called round tripping. Guys. Okay, is this clear, guys? Everyone? Anyone has doubt? This question is going to come. Okay, I'm gifting you this question. This question is going to come. Okay, even this question has a very high chance. This question also has a very high chance. I am gifting you 2 questions. Okay, everything which I'm going to tell is going to come in the exam. Just 2 days. Okay, in just next 2 days, you are going to see these questions in the exam hall. Okay, next is P notes. Guys, P notes are increasing in India. What are P notes, guys? P notes stand for participatory notes. They are issued by registered portfolio investors, registered foreign portfolio investors, to overseas investors who wish to invest in Indian markets without registering themselves. Okay, without registering themselves. Okay, this is called P notes. These are called P notes. P notes are used to invest in Indian equity, Indian debt, and hybrid securities. Okay, hybrid securities. This is clear, guys? Guys, are you able to follow, guys? Please do consider liking the video so that I get to know that you are able to follow what I'm going to teach here. Okay, these topics are very, very important. I have a firm belief that these topics are going to be asked in the examination, guys. Last year, I predicted so many questions. This year also, guys, I have a full faith that I will be able to predict at least 30 to 40 questions in the UPSC prelims examination. Guys, the cutoff these years are just around 75 marks. So guys, if you solve all the questions which I have given in my FLTs, if you go through all the important predictions which I have given you, I can ensure you definitely you will be able to crack the prelims examination. On the day of exam, you will see for yourself how many questions which I am predicting is going to come in the exam. So if anyone is having any doubt what to do in the next 2 days, just go through all my rapid revision. All my rapid revision is in the YouTube. Go through that. Next 2 days, you will definitely succeed in the prelims examination, guys. Okay. How many of you are happy with the revision sessions? Are these revision sessions helping you, guys? Are these revision sessions helping you? Okay. Next, very important topic is 81 bond. What is 81 bond, guys? 81 bond. Very important, guys. This is very important. Okay. 81 bonds are perpetual debt instruments. They are bond. Bond means debt instrument. They are perpetual debt instrument issued by banks to raise money and build up their core equity capital. Core equity capital, a perpetual instrument, is one with no maturity. So every bond has some coupon rate and some maturity, but these 81 bonds do not have any maturity. They are perpetual bond. This means, okay, the issuer, a bank in this case, does not pay the principal amount back to investor, but makes periodic interest payments throughout the life of the bond. In practice, however, 81 bond typically come with a call options, which means that the bank issuing these instruments can redeem them and repay the investors after a specified period. These bonds are introduced according to the Basel norms. Basel norms, guys, Basel norms is again going to come in this year's prelims examination. Basel norms for banking sector, Basel norms for financial sector, in order to protect from any crisis situation. Okay, you have to maintain a capital buffer. Okay, you need to maintain a capital buffer to protect yourself for any kind of crisis. Is this clear, guys? Is this clear, guys? 81 bonds, very, very important. 81 bonds, very, very important, guys. Anyone has any doubts? Anyone has any doubts, guys? Okay. Next, guys, RB introduces Basel III capital framework for all India financial institutions. Basel III capital framework. Guys, Basel norms. In UPSC, Basel norms, they have asked before also. Very, very important, guys. Basel norms are there for banking and financial sector in order to protect them from any crisis. So these norms basically mandate the financial institutions to maintain a capital adequacy ratio in order to prevent themselves from any kind of stress. Okay, guys. So RBI has introduced norms for Basel III capital framework, fundraising exposure guideline for all India financial institutions. Okay, what are all India financial institutions, guys? All India financial institutions are Exim Bank, NABARD, National Bank for Financing Infrastructure and Development, and the National Housing Bank, and the Small Industrial Development Bank, SIDBI. Small Industrial Development Bank, SIDBI. These are called all India financial institutions. These five are called all India financial institutions. Very important. Very, very important. They may give you the names of institutions and they will ask you which are the all India financial institutions, guys. Which are the all India financial institutions they can give you. Very, very important. Very, very important. Okay, guys. So now they will have to, okay, follow this Basel III norms. Okay, guys. Very, very important. Okay. Very, very important, guys. You can see here, all India financial institutions will be required to maintain a minimum capital of 9%. Minimum capital of 9% by April 2024, wherein minimum tier 1 capital will need to be at 7% and common equity tier 1 capital at 5.5%. Very, very important. Very, very important. Very, very important. Okay, guys. You may get this question, guys. Very high chance you will get this question. I have a feeling that they are going to give you this Basel norms. Okay, I think they will give you this Basel norms. Okay, very, very important. Okay. So, guys, what is this capital adequacy ratio? What is this capital adequacy ratio? It is a financial metric to gauge the ability of bank to withstand losses without affecting its lenders and depositors. Without affecting its lenders and depositors. Okay, so it is basically for resilience of banks and financial institutions. Resilience. How resilient a financial institution is. Okay, how it is going to withstand the losses. Suppose they incur because of NPAs or for any other reasons. Okay, while there is variety of capital adequacy ratio, it can be calculated simply by dividing the capital of a bank by its asset. So divide the capital of a bank with its assets and you get that. Okay, guys. So in case of heavy losses, the bank's capital takes the first hit before the funds of the lenders are affected. As banks and institutions that are run mainly through borrowings, even minor losses can completely wash out its capital. So capital adequacy ratio is the most popular measure for bank strength. Okay, very, very important. Capital adequacy ratio. Capital adequacy ratio, very important. This can be a question in the UPSC prelims examination. Next, guys, okay, you can see the capital adequacy ratio. Okay, RBI is basically trying to ring fence the bank. In this context also, RBI emphasized upon a 9% capital adequacy ratio. Okay, easy here. As per RBI norms, Indian scheduled banks are required to maintain a capital adequacy ratio of 9%, while Indian public sector banks are emphasized to maintain 12% capital adequacy ratio. Okay, guys, this is very important. This is very important, guys. Next, social bonds. Social bonds. What are social bonds, guys? The NABARD has launched the social bond, first social bond of India. First social bond of India, guys. NABARD has launched this first social bond. Social bonds will basically used for social enterprises. Social enterprises. Social bond is a type of financial instrument issued by government, international organizations, or corporations to raise funds for projects and initiatives that have positive social impact, which is basically social enterprises. Social enterprises. Okay, is this important, guys? This is very important. First social bond of India. Okay, important. Okay, NABARD. It is the first externally certified INR social bond in India. First externally certified. Okay, this is very, very important. Okay, so you can get a question on this. However, the Pimpri-Chinchwad Municipal Corporation in Maharashtra, Pune, and UNDP also launched a social impact bond in 2020. But this is the first externally certified AAA rated INR social bond in India. Very important. Okay, guys. So the money will be used for projects like green buildings, okay, storage, smart grids, etc., etc. Okay. Next, very important, guys. RBI has increased and revised the risk weight for unsecured loans. Unsecured loans. What are unsecured loans, guys? Unsecured loans are loans without collateral. Unsecured loans are loans without collateral. So, guys, for every asset or the loan of the bank, there is a risk. There is a risk which is attached by the RBI. Now RBI has increased the risk of unsecured loans, unsecured consumer loans to 125% from 100%. So it has increased 125% from 100%. Very, very important. This is a very, very important development. You can get a question on that. Okay, you can get a question on that, guys. Very high chances you will get a question on that. Okay, so this move is basically to protect the banks because of the increasing unsecured loans. There is a high chance these unsecured loans can turn out to be NPAs. So in order to protect the banks, RBI has increased this risk weighted of unsecured loans from 100% to 125%. So obviously this is going to now impact the capital adequacy ratio of the banks. This is going to impact the capital adequacy ratio of the banks. So guys, what is risk-weighted asset? Risk-weighted asset is commonly used in banking and financial regulations. It refers to the method of determining the minimum amount of capital that a financial institution such as banks need to hold to cover its credit risk. To cover its credit risk. In a nutshell, risk-weighted assets are calculated by assigning different risk weight to different assets. Different risk weight to different asset in order to cover the credit risk. In order to cover the, see, whenever bank gives credit, there is a credit risk. The money cannot come back. Okay, the money cannot come back. The money can turn out to be an NPA. So this is very, very important, guys. All assets of bank do not have the same risk. That is why the RBI has different risk for different things. For example, you can see here, cash has zero risk weighted. Cash has zero risk weighted. Government securities again has zero risk weighted. Then housing loan has 50%. Business loan has 100%. And now personal loan has 125%. Is this clear, guys? Is this clear, guys? Is this clear, guys? Is this clear, guys? Quickly, anyone has any doubts? Anyone has any doubt? Guys, are you able to follow, guys? Are you able to follow, guys? These are very, very important, guys. These are very, very important, guys. Okay, very, very important. Okay, guys, the capital adequacy ratio for commercial banks is 9%. Okay, 9%. Okay, guys, is this clear? Give a thumbs up to the video, guys. Write clear in the comment box. CLR, right? CLR, clear in the comment box. If you are able to follow, give a thumbs up to this video. If you are able to follow this, guys, this question has a very high chance to come in the exam. This question has very high chance to come in the exam, guys. I am predicting that this question is going to come in the exam. Okay, guys. Kavya has some doubts. What doubts you have, Kavya? Kavya has some doubts. What is the doubt, Kavya? Anyone has any doubts? Do hit the like button if you are able to follow this, guys. Do hit the like button if you are able to follow. Guys, these are very, very important topics. I have chosen each and every important topic, like you choose the diamonds. Okay, like that. I have chosen each and every topic is like a diamond for you, and these diamonds are going to come in the exam. These diamonds are going to come in the exam. Okay, guys. Okay, so this is the Optima card which I have prepared for you. Please go through this card. Risk RBI directive on risk weights. Very, very important. You may get a question on this. Okay, so what is the impact, guys? Credit growth will moderate. Obviously, the banks will be able to give less credit. Interest rates will increase on loans. It will impact the consumer spending. Bank adequacy, capital adequacy will also get affected. Okay, next sectoral impact will happen. Consumer goods will get impacted. Okay, so these are some of the impact. Next, guys, finance minister warns of unchecked explosion in F&O. Unchecked explosion in F&O. Unchecked explosion in F&O. Very, very important. Very, very important. Unchecked explosion in F&O. Guys, so let us try to understand what is this F&O. Very important. I am predicting this question. Okay, today in front of you, I am predicting this question. Okay, let this question come in exam. Okay, come in exam. Okay, let me just make a positive affirmation. Let me make a positive affirmation in front of this world. This question is going to come in exam. This question is going to come in exam. Let me try. Okay, let us see. Okay, guys. So first of all, to understand F&O, we have to first understand derivatives. What are derivatives, guys? Derivatives are basically a kind of financial contract which basically is based on an underlying asset, Okay, so the worth of a derivative is derived from an underlying asset. That underlying asset can be equity, can be anything. Okay, guys. So it is a financial contract that earn their value from an underlying asset. Okay, these are called derivatives. Okay, derivatives are of four types: forward contracts, future contracts, options, and swap. Forward, future, option, 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 and swap. So guys, out of these, only two are very popular. These are future and option. These are future and option. So what is future and option, guys? Future and options are financial derivatives that allow traders to speculate the price of the underlying assets, which basically give speculation. Okay, which give the holder of this future and options, okay, to speculate the price of the underlying asset. Okay, guys. So futures are what, guys? It obligates the buyers to purchase an underlying asset, while the sellers must deliver it at a predetermined price and a predetermined date. This means what? Future gives obligation. Future gives obligation. You are obliged to buy. You are obliged to buy that asset on a future date, on a future predetermined price, This is called futures. Okay. Options as what? Buyer has a right, but not an obligation. In options, buyer has a right, not an obligation. So what is more riskier? Futures are more riskier than the options. Is this clear, guys? Is this clear? Okay. But the seller has to honor the contract. Okay. If the buyer is ready to, okay, exercise their option. Is this clear, guys? Guys, are you able to follow? Are you able to follow, guys? Please do let me know in the comment box. Are you able to follow? Very, very important. This can be a question. This can be a question. Guys, you know, India's future and option market is larger than any country in the world. It is larger than any country in the world. Any country in the world. Any country in the world. Okay, it is larger than any country in the world. India's future option market is larger than any country in the world. Is this clear, guys? Are you able to follow this? Are you able to follow this, guys? Anyone has any doubts? Please feel free to ask. Please feel free to ask. Anyone has any doubts? Okay. It has a huge risk. It has huge risk, guys. You should not do future and option. Another is call option and put option. Options are of two types, call options and put options. They can ask you this also, but less chance. Mainly they will ask, okay, futures and options. What is the difference between futures and options? Okay, so call option, the holder right to buy underlying asset at a strike price, and put option right to sell. Okay, it is right to sell. Okay, call and put. Okay, guys. Next, guys, they may ask you what is the difference between IPO, then right issues, then offer of sale, then FPO. So, guys, IPO is basically when a company is introduced for the first time. Okay, when the company is introduced in the market for the first time, is traded, is called IPO, initial public offering. Initial public offering. Initial public offering. Okay, so this is very, very important. IPO. Then there is something called follow on public offer, FPO. It is when the company wants to raise more capital already in the secondary market. This is called what? FPO. This is called what? FPO. Is this clear, guys? Is this clear, guys? Quickly, quickly. Is this clear, guys? Quickly. Okay. Then, guys, right issues. Right issues is what? The promoters can choose to raise additional capital from existing shareholders. Right issue is only from existing shareholders. Existing shareholders will get an opportunity because they are getting at a discounted price. They are getting shares at a discounted price lower than the market price. Right issues. Right issues. Is this clear, guys? Right issues. Okay. And last is offer for sale. The promoters can choose to offer the secondary issue of the shares to the whole market, unlike right issues, which is only given to the shareholders. Okay, so difference between right issues and offer on sale is for, it is only for shareholders. Okay, guys. So generally this year IPO is very important. First time listing of companies called IPO. Okay, have you invested in any IPO, guys? The IPO of which company was a disaster? Last year, IPO of which company was a disaster? Can anyone tell me? Yes, IPO is for companies which are not publicly listed before. Very good. New companies. Okay. So can you tell me which IPO was a disaster, guys? Which IPO was a disaster? People are still in losses, huge losses. Okay. Paytm, guys, Paytm. Okay. Next, guys, QIP and QIB, qualified institutional buyers. QIB, guys, nowadays companies are raising capital through QIB. Nowadays, okay, companies are raising capital using QIP. What is QIP and QIB? See, QIB are qualified institutional buyers. So, guys, qualified institutional buyers are defined by the SEBI as per rules, are class of institutional investors that possess knowledge, experience, and resources to make well-informed judgments about capital market. They are qualified. They have a lot of information. Okay, guys, they are basically institutional investors. Example, mutual fund, insurance companies, foreign portfolio investors, commercial banks. These are called the QIBs, qualified institutional buyers. QIB, qualified institutional buyers. Is this clear, guys? Is this clear, guys? Very, very important. I think they may ask you this also. Okay. Next. Okay. This, I think we have discussed qualified institutional buyers. Okay. Go through it. Okay. Next is the domestically systematically in banks. Okay. Domestically systematic important banks. DSIBs. DSIBs. There are 3 domestically systematic important banks. One is the State Bank of India. Next is the ICI Bank. and third is the HDFC Bank. State Bank of India, ICICI Bank, and HDFC Bank. Okay, these are the three banks which are domestically systematically important banks because they have, okay, contagion effect, too big to fall, too big to fall. There are what? Too big to fall. Anyone has anything, guys? Anyone has anything important, guys? So what is the main thing, guys? Here they have to maintain additional common equity tier 1. They have to maintain additional, okay, CET. They have to maintain additional CET. Very, very important. Very, very important, guys. Very, very important. Okay, guys. Next, bank runs. What are bank runs? Okay, when all the depositors are withdrawing their money together, the bank will suffer from bank run. The bank will suffer from bank run. This is an important topic. I was expecting this question last year. However, they did not ask this question. This year they may ask. This year they may ask the question, guys. Bank run. This year they may ask the question bank run. Is this clear, guys? Next, the Basel norms. Basel norms, guys. Basel norms, again I told you. Okay, Basel norms are there. Okay, Basel 1, Basel 2, Basel 3. In order to protect the financial institutions, including banks, from any kind of crisis, that is what is the Basel norms about. It is about increasing the capital buffer so that the banks are protected from any kind of disaster. Okay, guys. So there is a committee on banking regulation and supervision practices, okay, which is now, it is called the BIS. Okay, you should, okay, this Basel norms can also come. They basically set norms for financial institutions, not just in India, but throughout the world. Okay, these are global norms for this. P notes I have discussed. Next. Guys, till now, are you able to follow, guys? Guys, are you able to follow till now? Anyone has any doubts? Anyone has any doubts? Okay, so guys, they may ask you simple questions. Sometimes UPSC can ask you simple question. This year they are going to ask you cash reserve ratio. This year they are going to ask you what is cash reserve ratio, what is incremental cash reserve ratio. Very important this year. So a certain minimum amount to be of deposit that a commercial bank has to hold as cash reserves, okay, is very, very important. CRR, cash reserve ratio. CRR, cash reserve ratio. Okay, very, very important. Okay. Next is the statutory liquidity ratio. So the banks have to keep some liquidity with them. Okay, that is called SLR. Okay. Then liquidity coverage ratio. Then priority sector lending. Okay. So guys, banks have to lend to agriculture, MSMEs, export credit, education, housing, social infrastructure, renewable energy. Okay, they have to give priority lending to these sectors for achieving inclusive growth. Okay, very, very important. Okay, PSL, priority sector lending norms. Next, guys, standing deposit facility, SDF. I was expecting SDF last year to only come, but I don't know, they did not ask you. SDF is for what, guys? SDF is for absorption of liquidity. Without any collateral. Again, I repeat, SDF is used for absorption of extra liquidity without any collateral. This is higher than the reverse repo rate. It is 6.25. Okay, it encourages bank to transfer money to RBI and reduces the availability of fund in the market. So when you want to suck the liquidity, use the standing deposit facility. Guys, very important. Very, very important. Okay, guys. Guys, till now, are you able to follow, guys? Anyone has any doubts? Are you able to follow? Guys, are you able to follow? Next, expected credit loss framework. So this is framework which has been introduced by the RBI. Okay, right now we are using the incurred loss model. Now RBI is asking that please go for expected credit loss framework in order to give more stability to the financial institutions. Okay. Next, RBI passes 2.1 lakh crore dividends. So guys, they may ask you, what are the income source of RBI? Guys? RBI earn money through open market operations. Okay, RBI get interest received from bonds. RBI may also profit from favorable exchanges in bond prices. Okay, RBI also earns money from exchange market. Okay, so RBI may also buy dollars cheaply and then sell them at a very high cost. Through this, RBI also earn money. But see, RBI is not to earn money. RBI is to regulate the financial market. Okay, but RBI makes some profits, and that profits RBI basically sends to the government as dividends. Is this clear? So they may ask you, what are the sources of income of RBI? They may ask you, what are the sources of income of RBI? Okay, guys. In the comment box, I am seeing some of the answers. Some of you are answering. What about others? There are around 100 people. There are 100 people, guys, but very few people are participating. What about others, guys? Why are you not participating? Are you not interested to crack the prelims examination? Please be more interested, guys. It is very, very important. Very, very important. Very, very important. You should definitely, okay, be ready for this. These topics are going to come in exam, guys. I'm telling you, these topics are going to come in exam. Okay, so guys, I think you know repo rate, reverse repo rate, bank rate, open market operation. Last year they asked question on open market operation. Okay, statutory liquidity ratio, SLR, CRR. Okay, these are expected. This everyone knows. Okay, next is Udgam portal. Udgam portal, RBI Udgam portal for, okay, unclaimed deposit. RBI Udgam portal for unclaimed deposit. RBI Udgam portal from unclaimed deposit. Next, IRDAI. IRDAI is a statutory body under IRDAI Act 1999. Okay, 1999. It's a statutory body, guys. It is a statutory body. You can. This is very, very important. It's very, very important, guys. This is 25 years. This is completing 25 years. That is why they may ask you question. What is Bima Sugam? What is Bima Sugam? It is a platform which is being built where all services regarding insurance will be provided at one platform. Bima Sugam. Bima Sugam. IRDAI is coming out with a platform called Bima Sugam. Okay. Next important topic, guys. You see, the minimum requirement of capital for small finance bank has been increased to 200 crores. From 100 crores, now it has been increased to 200 crores. So they may ask you, what are small finance banks? Guys, small finance banks are governed under the RBI Act. Okay, the small finance bank, okay, basically they need an extra capital of around 200 crores. Okay, so these are not the universal banks like the HDFC or SBI, etc., etc. They are not universal banks. There are some limitations on the small finance banks. Okay, you can see here. Okay, they have a minimum 200 crore capital. They extend 75% of the loans to priority sector. So they extend 75% of the loans to priority sector. Very, very important. They have to extend how much? 75% of the loan. So basically, small finance bank is for what? It is for financial inclusion. Priority sector lending, 75%. Very important. This is very, very important. Have 25% of the branches in unbanked area. Maintain reserve requirement. Capital loans to individuals and group at 10% and 15% of the net worth. Okay. Then they are allowed to sell forex to customers. They are allowed to sell mutual funds, insurance and pensions. They can convert into full-fledged banks after 5 years. They can convert into full-fledged bank. Okay. Also, so these are some of the, okay, limitations. What are the limitations? They can't extend large loans. They can't float subsidiaries. They cannot deal in sophisticated financial instruments. They cannot deal in sophisticated financial instruments. Is this clear, guys? Is this clear? They may also ask payment banks. What are payment banks, guys? Very, very important. Okay. So payment banks need is 100 crores, minimum 100 crores. Okay. So they can basically prepaid cards, telecom companies, NBFCs. Okay. They can basically, okay, promote the payment banks, and the minimum requirement is 100 crores. They have to maintain 75% of the deposit in government banks. They have to maintain 25% of the deposit in other banks. Have at least 26% investment by Indians. Get listed if net worth is more than 500 crores. Have 25% branch in unbanked areas. Be fully networked. Have 1 lakh cap for deposits. So anyone cannot deposit more than 1 lakh. Okay. So this is some. Okay. They cannot offer credit card. They cannot extend loans. Okay. They cannot accept NRI deposits. They cannot handle the cross-border remittances. They cannot handle cross-border remittances. So these are the difference between payment banks and small finance bank. Very, very important. Very, very important. Okay. Yes. Payment banks cannot offer loans. Payment banks cannot offer loans like other banks. Very good. Okay. Then guys, gift city. Gift city is important. Okay. Gujarat, I hope you know gift city. Okay. Then International Financial Services Authority. Okay. International Financial Services Authority. Okay. It is in gift city. International Financial Services Authority is a unified authority for the development of financial products, financial services, financial institutions in Financial Services Center in India. At present, GIFT International Financial Services Center is the maiden International Financial Services Center in India. Very important. Okay, very, very important. It is under the International Financial Services Authority Act. Okay, under a parliamentary act. This is under a parliamentary act. So GIFT City is in news. They may ask a question on GIFT City also. This is a very important development. Okay, they may ask. Okay, so this is a statutory body. Okay, and therefore what? Regulations in financial products, financial services, financial institutions. Like we have such kind of international financial centers in US, in UK. Now India is also trying to bring out an international financial services center authority. Okay. Next is, okay, sovereign green bond, guys. Basically, the money coming from sovereign green bond will be used for, okay, green projects. It will be used for green projects. So India has launched the sovereign green bond last year. Very, very important. I think the tenure is, I think 5 or 7 years. You can just check it out. Okay. Next. Okay. Next, guys, short selling. Short selling. Okay, guys. Short selling is allowed in India. Okay. But short selling in naked form is not allowed. So naked short selling is not allowed. Short selling is allowed in India. Short selling is allowed in India. Naked short selling is not allowed in India. Short selling is legal in India. Naked short selling is not legal in India. Short selling, both the individual investors and institutional investors are allowed. Individual investors and institutional investors are allowed for short selling. But naked short selling is not allowed. What is short selling? It refers to practice of selling a stock that a seller does not even have currently at the moment of transaction, and thinking that the price will go down. Thinking that the price will go down. Okay. So selling a stock which a seller does not currently own, thinking that the price will go down in order to make profit, is called short selling. Is called short selling. Naked short selling not allowed. Naked short selling not allowed. Okay. So this is very, very important. Short selling is legal in India. Many people will get confused, but it is legal in India. Naked short selling is not legal in India. Okay. So naked short selling refers to practice of selling shares that an investor doesn't own and has not even borrowed. As not even borrowed. Short selling, naked, often begins with intention of finding the shares to borrow, but short sellers is unable to do so. Okay, this is very, very important. Okay, so this is illegal in India. Naked short selling is illegal in India. Okay, guys. Next, insider trading. Insider trading is basically when you trade in any stock by knowing the confidential information. By knowing the confidential information is called insider trading. Insider trading is illegal in India. Insider trading is illegal in India. Very, very important. Insider trading. Next is front running. Front running is a malpractice generally by mutual fund, okay, managers. They will what do? They will basically, okay, they know that a big order is going to come, so they will first buy the funds there themselves, and then they will, okay, buy the mutual fund route. Okay, so front running means they are running before. Before you get to the order, you know that the order is going to come, you first buy the stock. This is called front running. Front running, very important. Last time only I think it was it may be asked, but they did not ask. Fat finger trade, it's a erroneous trade. It is an erroneous trade. Fat finger trade, by mistake you do it. Okay guys, next, private equity, venture capital, hedge fund. Guys, private equity is basically when you invest in a company which is already maybe listed or may not be listed also, but it's an already established company. Already established company, you want to own the equity of that company. Maybe the company is struggling. That is called private equity. Venture capital is for the startups. Okay, venture capital is for the startup which are not listed. Okay, and hedge fund are basically high risk funds. Okay, next, series A, series B, series C funding. Guys, funding types of IPO funding. Okay, sorry, types of startup funding. Types of startup funding. Series A is the first round funding, series B is the second round funding, series C is the third round funding. Okay guys, very important. Angel investors, they invest in series A. Angel investors, they invest in series A. Okay, very important. Okay guys, so we come to, I think we come to the ONDC. We have discussed before only. ONDC, it's a private non-profit company. Private non-profit company. Okay, it is basically, okay, incubated by Department of Industry, DPIT, and the Quality Council of India. It is basically for the e-commerce in India. Okay, next, de-dollarization of de-dollarization. Okay, you see throughout world now countries are moving away from dollar. Countries want to move away from dollar, and in this the rise of China is playing an important role. Rise of China is playing an important role, guys. Okay, so the US sanctions on Russia, the rise of China, the slowdown of US economy. Okay, then the trade wars, US-China trade wars. These are some of the reasons why most of the central banks now they are moving away from dollar. They are moving away from dollar right now. For international trade, every international trade is done in dollars. Okay, dollar denominated trades. But now, okay, they are going to move away from dollars. Even central banks, they want to move away to other currencies like the Chinese currency, etc. In this context. Okay, this is important. Next, Fed policy and its impact on India. So guys, Fed can raise its interest rates. This will lead to what? Rise in lending rates in India. Then it will lead to rise in deposits. Then it will lead to outflow of capital from India. This will lead to depreciation of rupee. Depreciation of rupee. It will lead to depreciation of rupee. Very important. Outflow of capital and depreciation of rupee and strengthening of dollars. Strengthening of dollar. Okay, guys. So this is it, guys. I hope the session was useful. Guys, please do consider liking the video. At 9 p.m. again, I'm going to come at 9 p.m. Again, I'm going to come and I'm going to give you the plan for tomorrow. I'm going to give you the plan for tomorrow and day after tomorrow. 2 days are remaining for the prelims examination. I'm going to help you crack the prelims examination. I will be there with you till the moment you enter the exam hall. Till the moment you enter the exam hall, I will be there with you. I will be giving you important topics, important questions. I will be helping you revise. Guys, last year, a lot of questions have come from our last minute revision. Our last minute revision is one of the best revisions in the entire country as far as prelims is concerned. Please do join me at 9 p.m. Please do join me at 9 p.m. Guys, is this clear? Guys, please do consider liking the video. If you think this video really helped you in revising the concepts which you think is important for the prelims examination, if you think the topic selections were very good, okay, and if you think, you also think that these topics are going to come in the exam, please do consider liking and sharing with your friends. And guys, if you know anyone who is preparing for prelims 2025, please do recommend our prelims mentorship program for them. Thank you guys. Bye bye. Take care. Please let us